you get the direction of the market from the higher time frame. It is not only from the daily. That is why I mentioned to you initially that your higher time frame, your intermediate time frame, and your lower time frame is relative. It depends on the trader, or it depends on whatever you want to do. Okay, at some point in time, your daily can be your higher time frame. Even the 15 minutes time frame can be a higher time frame. Take note of the general statement. Your directional bias is gotten from your higher time frame. So that means if your higher time frame is daily, then you should be looking to get the direction from the daily time frame. And if, for example, your higher time frame is 15 minutes time frame, then you should be willing to get the direction from the 15 minutes time frame. When you get the direction from the higher time frame, in the intermediate time frame, you want to mark your zones where you are waiting for price to get to, and you are waiting for price to get to that area of interest or that point of interest. Your point of interest could be a trend line that you have drawn on the intermediate time frame, and you are waiting for price to get to that trend line so that you can trade from the trend line. Your point of interest can be, or area of value, people call it different names. Your point of interest can be a support and resistance line or zone or area, whatever it is. Your point of interest can be a supply or demand zone or an order block or whatever it is. So on the intermediate time frame, you just simply mark your point of interest. Then you wait for price to get to your point of interest. Immediately price gets to your point of interest, you now scale down to your lower time frame, looking to enter from your lower time frame. So that's the simplistic way you can actually apply this. There could be more. There's no one particular way of trading, okay? But do it in such a way that is rule based and there's no much confusion in your trading. Make it simple as possible and follow the rule all the time. Okay? So that is exactly how you're supposed to go about it. Once again, on your higher time frame, daily or whatever it is, why am I saying sometimes 15 minutes can be your higher time frame? If, for example, you want to enter on a 1 minute, okay, your entry time frame will be 1 minute, which is equivalent to your lower time frame. So in that case, your 5 minutes time frame might be your intermediate time frame, while your 15 minutes is the higher time frame. You start looking for direction on the 15 minutes time frame, okay? Then on the 5 minutes time frame, which is the intermediate time frame or the middle time frame, you start looking for your zones from which you want to trade from. When price gets to your zones on the 5 minutes time frame, you scale down to the 1 minute time frame and start looking for entry on your lower time frame. So these things are relative. But just know what you are doing on your higher time frame, on your middle time frame, and for your lower time frame or entry time frame. Okay? Let me just apply this process to what you have listed. Daily, 4 hour, 1 hour. On the daily time frame, for instance, you are going to be looking for the direction that you want to trade from. You want to look for the expectational order flow, the direction of your daily time frame of the market from your daily time frame. Then on the 4 hour time frame, you are going to look for your zones, your point of interest. You are waiting for price to come to that point of interest, then you trade from it. When price gets to the point of interest, what do? You scale down to your 1 hour time frame and look for entry. As simple as that. Okay? Alright, so let's go. Now we have this bullish trend. On the daily, how do you know which direction you have to look for? Whenever we have for instance, we have let's say this. Sorry, whenever we have something like, sorry, just take note of this. Whenever we have, for instance, a bullish break, this is a bullish break, okay, your expectational order flow is bearish, okay. The reverse is the case if we have, on any structure at all, if we have a bearish break of this, your expectational order flow is what? Is bullish. So that means the direction that you want to trade from is going to be bullish direction. Okay, now quickly let's see this. Sorry about that. You want to shift this. Alright, so let's go with this. Now on the daily, once you notice any break of the most recent break of structure, just go to the daily time frame. Look for the most recent break of structure on the daily time frame. In this case, let's say the most recent break of structure is bearish. Once it's bearish, that is all you want to know. Your expectational order flow is going to be bullish. So it means you want to look for bullish trade. You want to look for opportunities to buy. Okay, so once you just see this break bearish, just know that you are looking to buy. For now, there are different strategies, but I'm just explaining this strategy for you. Okay, once you see this bearish break, know that your expectational order flow, this is the expectational order flow, is what? The order flow that is being expected is bullish, and that is what you are going to, that is the trade you want to place on the lower time frame, which is the 1 hour time frame. So we have the daily, the intermediate 4 hour H4, and the lower time frame, in this case H1. So you can have something like 1 hour as the higher time frame. Here can be 15 minutes, here can be 5 minutes or 1 minute. You can even have here to be weekly, you know, here could be daily, and here could be 4 hour or 1 hour. You can have here to be 15 minutes, here could be 5 minutes or 3 minutes, here could be 1 minute or so. Alright, so these are relative, they are all relative. Now let's go with this daily 4 hour and 1 hour. Once again, I said if you see this bearish break, your expectational order flow is what? Is bullish. Okay, so that's your directional bias for this particular pair. For example, once you have your expectational order flow to be bullish, you just go and you want to examine what you are looking for is the change, because you are looking for for bullish move. You want to observe this leg on the intermediate time frame. You start looking at the structure carefully on the intermediate time frame, which is the 4 hour time frame. And what are you observing? You want to look for change of character. In this case, the break of this lower high. That's what you want to look for. You want to look for the change of the character. Once you see the change of character, what do? You mark your zone. What zone could price actually return to? Because when you have this bullish break now, here is bearish break, here is bullish break, price is fractal. You are doing everything on all. You are doing almost the same thing on each time frame. You have a bearish break, expectational order flow, bullish. You have a bullish break, expectational order flow, bearish. Okay? Do you understand me? Do you understand me now? Because once you have this bullish break, alright, you now know that price is ready to make this move. Okay, so you now mark the zone like I used to trade. You look at any zone that is responsible for taking this high. Okay, you're responsible for this bullish break. You mark the zone. What is this zone? This is your point of interest. You are waiting for price to come down to this zone and you take your trade. Okay, it is either you wait on this time frame until price actually comes down to this zone, then you switch to your lower time frame, or you switch to your lower time frame immediately after this break, and you start monitoring what? This structure, this leg BC. You start monitoring what? BC. Remember, after the break of this, you started monitoring AB on the 4-hour time frame. Okay, now after the break of this, the change of trend of this 4-hour structure, you started monitoring this leg on the 1-hour time frame, this BC. Forget about this, we are looking at this. Why are we monitoring this? Because we are looking for the change of character here. It's a change of character. Okay, we are looking for the change of character here. Once we get the change of character, some persons can also trade here, but we are not focusing on that yet. You know, when you grow, you know how to do all those things. So when you get the change of character, then you are rest assured that price wants to make this move, okay, down to your point of interest that you have already marked. Okay, now you are on your entry time frame. When the price gets to your point of interest, you want to see a change of this trend. This is a downtrend. You never knew if this downtrend will continue going down. So what you need to do is to confirm that this downtrend is over by another word, change of character. You want to confirm that this downtrend is over by another change of character. And eventually, when you have this change of character, there is a zone that sponsored it. There is a 1-hour zone that sponsored it. Now price has already got into our 4-hour zone. Okay, now we want to see a reaction, a change of character from this 4-hour zone, and we have seen that change of character on the 4-hour zone. You now look at the zone on the 1 hour. You select a zone from the 1 hour that actually sponsored this, okay, and wait for price to return to that zone, and this is where you're going to take your trade from, in line with the daily directional bias. In line with the daily directional bias. You want to trade in line. This is bullish, this is bullish. You want to trade in line with the daily directional bias. Okay, that is exactly how you're going to do it. Once again, on the daily, you look for the expectational order flow, which is the directional bias, or the direction. You look for the direction, as simple as that. If we have a bearish break, our expectational order flow is what? Bullish. You want to go for bullish trade. Then on the 4-hour time frame, you start monitoring this leg for a change of character, which is this. Once you notice a change of character on your intermediate time frame, you can easily quickly scale down to your lower time frame to monitor this leg for another change of character, which is BC. On the 1 hour time frame, this is BC. You monitor this leg for a change of character. Once you see a change of character, you are rest assured that this move is beginning, and at this point in time, you are waiting for price to come to your point of interest, your 4-hour point of interest. You know, that's what you're doing now. It's a 4-hour point of interest. You're waiting for price to come to your 4-hour interest. Some persons may want to trade. You know, some persons may want to trade this. They may want to trade this, okay, but I will advise you just to trade the bias. Okay, this is kind of a little bit risky. Okay, this bias is easier. Okay, then after price gets to your 4-hour, what you are looking for now is a change of this trend to confirm that this trend actually wants to shift what? Bullish. Why? So that it will be in line with your daily directional order flow. This is the most profitable kind of trades. So when you have this break of structure here, you now look for the 1-hour zone that actually sponsored it. Okay, the 1-hour zone that actually sponsored this, that actually led to this break. Okay, sorry about that. And you mark the zone. Wait for price to return to the zone. Wait for price. I want to zoom this. Sorry, I didn't use this too well. Let me pick it. Oh, jeez. Oh. What have I done? Sorry. Okay. I wanted to just zoom this area a little bit. Let's try again. Let me try again. No. Look at the zone I marked. Doing very well. Coming down. I didn't take trade from here. It would have been very lovely. I didn't take trade from there. Okay, that's just by the way. Alright, so now on you just wait. What zone on the 1 hour actually break this? So you wait and take your trade from here. Sorry for dragging the video too long. Alright, thank you.